Right, good evening. This is Ken Long with the review of the weekend trading reports for January 17th, 2016. This one is really pretty straightforward. It has everything to do with market condition and much less about targets that can be found in the swing trading or day trading arena. Um, the market is dominating the news and is such a central issue for analysis that if you get the market call right, the rest of it will go right. So we're going to focus mostly on market stuff tonight. The market is in bear volatile conditions, as you can see. On an annual basis with weekly RSI 14, it's in the lower portion of neutral with a score of 37. If it goes below 30, that becomes significant on that indicator. But the drop from 55 to 37 is quite a large move down. On a 10-day basis, using 10-day NDX, we're oversold at 14 out of 100. Price relative to the 200 is red bearish at minus 7.69. So we're over 5% deep into the bear. Slope of the 50 is red bearish at minus 0.9. ADX is strongly trending towards the bear at 30.2. The ATR percentage at 2.05 is 3 times as volatile as it was about 5 weeks ago when it was down around 0.75. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. The current reading at 0.843 is deep into risk off. When you compare that to the last 5,000 trading days, we're minus 1.91 standard deviations below normal, below average. And this histogram is the last 90 days of that. What you'll notice is that we have a series of 3 lower lows. We're down around minus 2 sigma. And the highs, it was positive 3 sigma, then just a nudge into the green. This one only got to break even and before it failed. So now we're at minus 2 sigma with no end in sight. So that is a very bearish market condition, excuse me. This is the blended monthly rebalancing holdings from the start of the year. Reevaluation is due on or about 1 February. These are the holdings suggested by the prices as of Friday's close of business. And then the leaders in the other portfolio categories. Theoretical exposure in ETF2s at 0%, and the model portfolio is at 70% with stops in place. Just a quick look at the blended monthly rebalancing portfolios for ETF 13 and 32. Just notice it being dominated across the board by red and the defensive plays of XLU. Just notice how bad ILF continues to be. On a blended basis, it's down 24%, whereas U.S. real estate's down 4% on a blend. So we get paid to know where the weakness is so that when the market rolls over, we can exploit the downside as well. As long and strong, you want to be short and weak. Among the ETF max, all of these winners tend to be inverse funds or short-term interest-bearing accounts. It's interesting to just notice the preferred stocks are in there as well, like PGF, financial preferreds, and PSK, the Wells Fargo preferreds. In the S&P 500, just want you to notice the damage being done among the NASDAQ high-tech things here. We get Amazon down 7.5%, NVIDIA down 8 2/3%, First Solar down 6.25% over the past week. And so the weakness in technology is very troublesome for those leaders. All right, next up is the market health check. It's not very healthy at all. The vertical blue lines are 10, 20, and 30 days worth of look back, and 60 days. The horizontal purple lines are price levels that used to be support and are now resistance and are now targets for price movement on the way back up. The support level, the last support level on the map here at 187 is the support level from the end of September, which if that breaks, there's another 10% downside immediately available. So all of this nice move from end of September through early November is gone and has been evaporated in about 10 days. I'd like you to just notice the, let me pull this up a little bit further so you can see it. There we go. Percent price oscillator down here, the PPO, with the settings of 10, 20, and 8, did a pretty nice job of giving us the early warning here 10 days ago that the weakness was inherent and the jaws open to the downside. You may recall us talking about that. The same way that it did here. Quickly reversed itself back in early October for the long run up. So as a swing trade guide, that's not a bad way to get a quick and dirty direction of the tide, which way it's leaning. Right now, it's still open to the downside. Jaws are showing no signs of slowing down or coming together, so it's clearly a downward bias. You can see that we're deep into price below the 200, which is up here. The Bollinger Band mean is now below the 200-day moving average. The dragon is almost entirely out of the river. The 10-period regression line channel is extremely tight and steeply, sharply pointed downward. And the 30 has rolled over as well and is also downward. The slope of the 30 is at minus 0.50, which is twice as steeply down as the marker for significant downward slope is minus 0.22 in the slope, and it's at minus 0.5. So this is a considerably steep downward slope of the last 30 days, going from 210 to 187. That's 23 points on 210, so it's about almost 12% in 30 days. We'll see later that that's compared to the last 5 years. That's last 10 years, excuse me. That's the fourth worst 30-day period in the last 10 years. So that's not good. Next up, the regional report, everything on cash, no surprise. The S&P at 59 is still better than EFA at 52, so it's the U.S. over the globals. Inside the U.S., technology has pulled back. It used to have a great big lead over everything else, but technology has now pulled back to being just a little bit better than the S&P, then mid caps, then small caps. The S&P and the NASDAQ, the two strongest. Latin America and emerging markets are the weakest at 38 and 42, respectively. In the sector spiders, only utilities are very strong right now. Everything else is on a cash position below their 5-week moving average. In the world market model, you notice everything in the U.S. is below average, with the exception of those large caps and then mid-cap growth. But the yellow indicates in the third quartile of the database. Japan, China, Indonesia still above average, but China not for much longer. Latin America, emerging markets, Canada, Brazil getting crushed. Commodities and oil getting crushed. Gold and silver kind of on a rebound now, along with treasuries and corporate bonds and U.S. real estate. Everything Europe is looking weak except for Belgium temporarily. So gloom and doom around the world. Everything in the ETF top 30 looks like these short-term bond funds. No surprises there. In the Dow 30, even the worst of the blue chips are in the yellow. And then the top 5: McDonald's, Microsoft, GE, Travelers, and Coke, doing pretty well. Walmart had a nice bounce on the basis of the announcement of how many stores they were going to close. ETF liquidity. It's interesting to note that the technology shares, the NASDAQ Qs, have now caught up to the small caps of IWM in terms of average daily dollar volume. And I think that's reflecting a lot more people cashing out their winning positions and raising the daily volume in tech. Shifting to the daily report, just about everything in the Dow and the ETF 30 are firing on the Autoframer because the distance to the 10-day high is so large. Lots of channeling and overreactions, but I wouldn't take them unless I saw positive evidence of price movement on a given day. And I would wait, and I would be inclined to harvest those on a day where it made money. I would use them to get started on a day trade, but I would be reluctant to hold them overnight until the market has found its own support levels. Same thing we're seeing in here with the ETF 30. Just about everything fires on the Autoframer 15DD down here in U.S. real estate, which also comes in at a 2 on RSI 2. So really throw a dead cat in there and you find something that has a long way to go to get back to its 10-day moving average. No surprise there. Lots of charts frame out well on the Autoframer. So if we do get one of these bounces on Tuesday from a bear market, it's not unusual to see big one-day pops there until price closes and settles above the 200-day moving average for the S&P. I am much more inclined to take the gains during the day and not have any overnight exposure. So no difference from the usual there. The RLFF, the regression line fractal, has a lot of interesting choices as well. Only one chart out of all the targets fires on the pop on the intraday, on the daily squeeze, and that's BHI, Baker Hughes. Looking at some of the supplemental charts here, you can see the slope of the 30 is down steeply and accelerating to the downside. That's what that polynomial black line regression shows. The acceleration is to the downside. You can see here the slope of that 30 is 2 standard deviations almost below the long-term average. And you can see, I want you to just notice how smooth and decisive the indicator is for the slope of the RL30. When it crosses its own 10-period moving average at a distance of more than 1 SD away from the long-term average, you notice here it made the crossover down here and it led to a nice gain. Up here it made the alert, said, hey, time to be careful and lock in those gains. Troubled seas ahead. And so we're now almost 2 SDs below the long-term average. We haven't crossed back to the upside yet, but when that cross occurs is when I'm going to shift my bias to the long side. I will use this as my daily guide for when to have a bias long or short. Once the blue line, the regression line, gets outside of the plus or minus 1 zone, then I pick up a strong bias in that direction until it crosses its own 10-period moving average, in which case I look for the other side of the trade. Looking at the market mosaic here, I just want you to notice, looking back over the last 10 years, this slope that we have right now of the 30-day regression line, there's only 3 times in the last 10 years it's been worse than this. So that's how bad that last 30 days has been. You can see that by all our measures of volatility, price is becoming officially noisy. Just going to flip through the stats portion. You can stop that later if you want to look at it. All right, on the z-scores of the three regression lines, the 10, the 30, and the 90, just notice that the 90 has come back to the midpoint now, the long-term average, or the long-term baseline, yeah. And then the 30 has moved from plus 3 SD to almost minus 3 SD. And that's exactly how bad it was the last time that it made a nice strong move. So that doesn't mean this is going to continue downward. But the 10 has already made a tiny little turn, and on Friday held the bottom. But it can get a lot worse, as we've seen over here when it got to minus 6 SD. So this, until proven otherwise, this is still just a temporary pause to the downside. But we're well postured now for the kind of rebound off of this support level down here around 190. So we'll see what happens down there. If that price level collapsed, then 180 and 170 are both in play. The last thing I want to show is one of the last charts here. And this is just the phenomenon of bear markets, that what these two charts reflect is the degree of correlation between the 30-period regression lines slopes of these different indexes compared to the baseline. When it's around 0, that means it's strongly correlated with the U.S., the slope is. And what I want you to notice that the tighter correlation is occurring. These are now becoming exceptionally tightly correlated. Only Japan is really still below the 0 line. So very strong correlations between all the indexes and the U.S. This lower chart measures the distance between the correlation of the most and the least correlated, and it gives you some sense of how tightly compressed are these world indexes and in sync with the U.S. market. And when they get abnormally tight, this goes below the 0 line, like we are just starting to now, and that means that the whole world has just now started going down together. When it's highly uncorrelated to the upside, that means that there is divergent performance between these different regional indexes, and that money is actively hunting out one region at the expense of another and getting unequally weighted, and that's where you get the change in performance as the long-term allocations are getting out of whack. You see performance start to differentiate. When everything starts going down together, however, you just noticed how quickly those correlations tend to converge at a high level, and that's why we're on average now up above 1. The average correlation is really probably about 1 full standard deviation above normal. That's what this chart means. So this means the whole world has started to go down together, and more to follow because we just went below the 0 line now. That should not comfort you unless you have short positions. Okay, so that's everything that I wanted to cover on the from the daily report this weekend. We have a day off tomorrow with Martin Luther King Day. Good time to reflect on larger meanings in our life. So I'm preparing my final notes for the online swing trade workshop. The best of that is going to form the basis of the Advanced Swing 202 course that I teach in April in Raleigh. So I'm going to be recording portions of this online version to be used as read-aheads and supplements for that other the IITM course, and I'm going to probably make these recordings available too once we get all the lessons and everything done. And so that's going to be probably 10 weeks worth of study material. It'll be online lectures, some reading material, focused homework, case studies to work on individually and then collectively, and then question and answers between me and the guys that are taking the course. So we're looking to start that off. I hope to have it done, ready to go by next week, and then turn that into a home study course shortly thereafter for advanced swing trading. So there we are. Get the market call right. Keep your powder dry. Let the market's direction each day get you into the side, and so to the side of the trade that you want to go into, and you should be following the market, not trying to anticipate where it'll turn. Follow the elephants or the buffalo. Just don't try to convince them or persuade them. Just follow them and be amazed at their power. Okay, so that's everything I wanted to cover tonight. Back to the salt mines for me. You guys take good care, and we'll see you in the chat room.